Hey, everybody, welcome back to another episode. Today, I've got Mark Willis on the show. He is a certified financial planner. He is a three-time #1 best-selling author and the owner of Lake Growth Financial Services, a financial firm in Chicago. He's the co-host of Not Your Average Financial podcast. He shares some of his strategies for investing in real estate, paying for college without going broke, and creating an income in retirement you won't outlive. There's some cool stuff that I'm excited to jump into with Mark today. A lot of people think the financial system is broken. You know, people are rewiring how they think about retirement because the game has changed. And he's got some cool stuff and some unique perspectives on whole life insurance. So if you think that you've heard it all before, stay tuned. There's a different spin that I'm excited to jump into with Mark today about the whole term life insurance strategy here. Mark, welcome to the show.
Hey, glad to be here, Brandon. Thanks so much for having me on.
Yeah, no, it's a pleasure. So, for those that don't know who you are, what's your story?
Well, I love what you've got on your wall behind you. It says, "Stay hungry, stay humble." That's sort of the first, few years, and I'd like to say for the rest of my life, that's going to be my default position in life. But I went through graduate school, got out of there with a master's degree, graduated in 2008. Wonderful time of the economy to look for work, by the way, 2008. So we had no jobs. We had six figures of student loan debt during the worldwide recession, the great financial crisis of 2008. We were working every side job we could get, including property management. And my first job, speaking of staying humble, my first job, I was handed a wet dry vac, basically a shop vac, and I was told to get under the elevators of this brand new building this property management company had purchased and was there to rehab. And my job was to just basically suck out anything you could find from underneath that elevator. Legal and illegal stuff came out of that experience, let's just say. So I was very humbled after my nice, fancy looking master's degree to get, down on my hands and knees and have to clean out under elevators. Uh, in addition to that, staying hungry. I was, six figures in student loan debt. We would eat rice and beans, and on Friday nights, we'd switch it up and eat beans and rice. And that's basically how we lived our life, man, for many years. And we were following the Dave Ramsey model. I know he's
Yeah.
right up the street from you there. And so we were doing his thing. And until a professor of mine came from college and he knew that we were in all this debt. He knew that we were laser focused on being debt free. And he came to us and he said, "Mark, I've got something important to talk to you about. Let's set aside some time to discuss it." So we did. And he said, he looked at me in the eye and he said, "Mark, is it possible that Dave Ramsey could be wrong about something?" And he just sort of let that question hang there for a second. And I had never really let that thought cross my mind. In my mind, Dave Ramsey had written the fifth gospel and everything he said was pure truth until I started digging in and realized, wow, wait a minute. There's some things here that he doesn't mention either because he doesn't know about it or he just doesn't have the ability to be nuanced on a radio show. Go figure, he's not a financial planner. He's a radio host. His only license is a radio license. So the more I dug into, well, what is the truth about how money really works? The more I realized, wow, I could use, of all things, a dividend paying whole life insurance policy to wipe out my debts and become not just debt free, but be better than debt free. And so this was kind of my breaking point. I realized, wow, I've got to re-understand how money really works. And a lot of people think, well, wait, why whole life insurance? I guess we can get into that some, but that's sort of where we had the fork in the road moment, you might say, my wife and I. And since then, we've been able to serve clients in all 50 states and really around the world. I've been privileged to be a certified financial planner for my clients and serve as a fiduciary. And from there, we specialize in helping people not just with the bank on yourself type whole life policies, but in a comprehensive financial plan that helps them reach their goals without taking a bunch of unnecessary risks.
Give us some teeth here. So, you use this vehicle in order to help expedite and pay off your student loan debt. What do the numbers look like? How did you do that?
Yeah. Well, we had about $120,000 of student loan debt at the time, and we were just throwing money into the hole. Now you think about that. That feels good for the moment. Oh, wow, we look at all the debt we paid off
Yeah.
until you get that empty feeling in your bank account. I call
Yeah.
paying cash for things is not the answer. I call it the sugar high of finance. Because when you pay cash for something, you lose the opportunity to grow that dollar for you ever again. It's now in the
Right.
banker's pocket, working for his retirement, her retirement. So yeah, we threw some money at the problem, and then we found Bank on Yourself. So we cooled it on overpaying on our debts, and actually we trademarked the phrase the Debt SnowBANK method as a result of all this. So the Debt SnowBANK method follows these steps. Number one, keep current on all your debts, and that's what we did. We had a minimum of about $800 a month at the time. Step two, we overfunded our whole life policies as much as we could put into the policies. We just packed them in there. And over the next year or two, we continued to just overfund our policies, just slamming money into that. So if you can imagine, Brandon, the money in the policies was going up while our student loans and other credit cards and other things was coming down. So at some point, as we went along that journey, the policy and one of our debts was equivalent to each other. So we would simply, step three is borrow against the policy and wipe out one of our debts.
Yeah.
All right. So now we've paid off the student loan and we have a loan against our life insurance. Step four is we repay.
What was it, a lower interest rate, right? Like the debt on your, let's call it, student loans and credit cards. That was a certain rate, because I think this is easy to understand. These whole life policies are very easy to borrow against. You can get great terms with it. So you had built up your whole term life insurance policy up to a certain point that equaled the number of credit cards and student loan debt that you had. You borrowed money against your policy, paid it off, and now you're making payments. You don't have the high interest credit cards, student loan debt. You've got the lower interest, like whole life. What were those numbers, by the way? I think a lot of people know like what student loan debt is, and credit cards, it can get as high as 20%. I know friends and family who have like 7-8% loans on student loan debt. Like what was the arbitrage? What were you paying on the loan against the whole life policy?
Whole life policies are surprisingly affordable, and because if it's designed the Bank on Yourself way, and I got to keep saying it that way because there are a lot of other nicknames out there, infinite this and family wealth banking that, and there's a lot of nicknames out there. None of them have any kind of credentialing process or training for the advisors that sell that stuff. And often, very often, I will be given a illustration of one of these policies that some other agent or a financial advisor built, and the advisor swears up and down they can design these policies properly. And then I look at it, and unfortunately, it's a tax nightmare. The policy does not grow on the rate that they thought it would grow at. The loan rates are problematic. The policy will stop growing. So let me back up for a minute and just say, let's call them Bank on Yourself designed policy, whole life policies as a nickname here, just to keep all this short. But to answer your question, loan rates are simple interest all year long. Simple interest. Can you imagine if your mortgage was simple interest all year long?
Yeah, for those listening that don't know what simple interest is, it's where you're just paying the interest. So a lot of times when you're paying like a mortgage payment, there's a principal to it. Simple interest means that it's just interest, so it's usually a much lower rate.
You're not compounding interest upon interest. So in fact, as I make a loan repayment on my policy, it goes directly to principal all year long, and I'm not servicing interest all year long. Now, it only compounds annually in arrears. And so this has the net effect of lowering my annual percentage rate pretty dramatically. Just to give you some idea, with these terms on the loans, it's going to be over 4 years. If it took you 4 years to borrow money out for a car, let's say, pay it back, you'll pay about 2% APR, annual percentage rate, 2%. So that's pretty darn good. At the same time, however, the policy, and this is the big part here, and this is what I think changes everything for your listeners who may be interested in real estate. So when you borrow against these policies, if it's designed the Bank on Yourself way, the policy is not interrupted in its compound growth. It continues to earn interest and capitalizing its dividends on the full cash value as if there was never a loan taken, Brandon. So this gives you the chance to have uninterrupted, guaranteed compounding growth. That guaranteed word is a very hard word to say in the financial services world. But as it's an insurance contract, a whole life insurance contract, it is absolutely contractually guaranteed to grow every single year at a faster and bigger dollar amount every year you own the policy, plus dividends laid on top of those guarantees. All right. So, and when I borrow against that ever increasing bucket of money, my policy does not diminish its compounding. When you spend money out of your savings account, again, it stops earning interest, right? That's like finance 101. When you withdraw money out of your bank account, boom, that money's gone. Also gone is all that savings account would have earned for you had you not bought the ice cream cone or the Tesla or the kids' college. But if you can borrow against your life insurance to pay for those kids' colleges or my student loans or the Tesla or whatever, or the real estate property, that policy will still earn interest and compound dividends for the rest of your life, even as you have that loan outstanding. So that to me beats paying cash for any major purchase or debt repayment.
What would be the advantage to, somebody taking money and they're trying to design a whole life insurance policy versus investing in a stock market index fund? Because that's the kind of the same way. Like you invest money in the stock market index fund, it compounds, right? That stock starts to grow, and if it pays dividends, the dividends get reinvested back into purchasing more stock, and so that'll grow. And someone might go, oh, you know what? I don't want to sell my stocks. I'll just take a loan out against them and use it for whatever I want, and then just make repayments back to the company I took the loan out against. So you're kind of doing the same thing with the whole life insurance policy. What would be like the advantage of doing that versus that the stock market example?
Oh man, such a great question. So a couple of things to keep in mind. One, what in the stock market is guaranteed? Nothing, right? The values of your stock can go down. And in fact, what you're describing is a smart strategy. In fact, the Treasury Department was hacked a few years ago, and the 25 wealthiest billionaires, their tax returns were publicly on display. You can look this up, the ProPublica Treasury data dump from 2022, I believe. And Elon Musk, Michael Bloomberg, Mark Zuckerberg, all of these major billionaires use the buy, borrow, die strategy. Buy, borrow, die. Buy assets, specifically assets that don't produce income, because income is taxable. So they would buy stock in their share. Warren Buffett would buy shares from, Berkshire Hathaway, and then borrow against those stock assets to live on or to invest, et cetera, never paying taxes because loans are not considered income by the IRS.
Yep.
The only problem is margin calls happen, and there's a forced repayment on anything that is not in your control. So a margin
if the value of that stock declines past a certain point, they're going to go, hey, your asset that you put up as collateral for this loan is getting too close to the loan amount. You need to go ahead and pay us back, or we're selling and liquidating your stock.
A banker is a fellow who will lend you money when the sun shines, but he wants it back as soon as it starts to rain. We know this from Mark Twain, right? So the truth is that happens with home equity lines of credit, personal lines of credit, business lines of credit. We can borrow against almost any asset, but the problem is who's in control. So the advantage of the whole life policy is there is no required repayment plan, and here's why. You are self-collateralized, meaning if you never pay off the loan, and as long as that policy remains in force throughout your lifetime, the death benefit nets out any loan balance when you pass away. So if I've got a $2 million death benefit and I've got a $500,000 policy loan on my policy, my family would get 1.5 million bucks plus the real estate I'd used to borrow from my policy to purchase the real estate or whatever it was I used to buy in my lifetime from the policy loan. To me, that's a huge advantage because, Zuckerberg and Musk and these guys would have to have a capital call or whatever to make good on whatever margin call was made. Not so with my policy. My policy grows guaranteed every single year for the rest of my life.
Wow. Lots said there. So you've almost got a guaranteed rate that compounds on itself in the whole life insurance policy. Whereas with doing that strategy with a stock portfolio, you can have a margin call on you. Stock's not guaranteed to go up at all either. So
And
big
the rates
things.
can change and so much can happen. And that might not be your problem. It may not be the stock's problem. It might be your financial institution has some sort of a cash crunch, and they just have to lower your line of credit or, freeze your line of credit or term you out. I had a business owner, he had $1 million line of credit against some equipment in his business, and he used it all the time to operate his business. The bank got in trouble, not him. His business was great. The bank got in trouble. They called him up, termed him out, said, "You got to pay us $1 million. We're exiting your business. In the next 5 years, you got to pay up." He was furious. He said, "I never want to darken a door of a bank ever again, except for cash checking and savings accounts. I never want to borrow or kiss that ring of the banker ever again." So he set up his whole life policy, put $1 million of cash value in there now, and he's never looked back.
Wow. So yeah, borrows against that. On this call, we were talking about the difference between executing a normal whole life policy and the bank on yourself concept. And you've got a pretty nuanced approach to this bank on yourself. What's the difference and why is it beneficial?
Well, yeah, like I said earlier, there are 400,000 life insurance agents in the United States alone, Brandon. So you can guess that's about one for every 800 Americans, give or take. So you could throw a stick and probably hit 2 or 3 licensed insurance agents in any crowd.
Yeah.
And that does not mean they know anything more than our listeners already know about these type of policies. In fact, I would say what you don't know, what your agent does not know, can hurt you, because you can design a policy poorly and sell it like it's a infinite wealth accumulating, family banking, cash flow multiplier. I mean, there's so many nicknames out on YouTube for all of this. And again, once again, I've counted at least 29 different nuanced levers and pulleys and dials that we have to design this policy properly with. It's kind of like when you go to the grocery store, you can get an apple or you can get an organic apple. And you know both of them grew off a tree, but you know one of them had to go through a number of different hoops and hit certain metrics and be a certain caliber of quality. There was somebody watching how that thing was treated, whatever. So you've got a assurance when you get that USDA organic seal, you know that that apple has hit certain levels of, quality. And that's what Bank on Yourself is. I mean, I'm not their owner. I don't own Bank on Yourself. It's a different certification and authorization program. It's the only certification and authorization program in the financial industry that follows and tracks this type of asset class. So there are a lot of other weekend seminars you can go to, but there's nothing that looks over your shoulder as a financial professional and makes sure that you're doing the right thing for your clients, like Bank on Yourself. It's the equivalent to the CFP, but on the insurance asset class side. So if you're going to do this, whether you work with me or with somebody else, make sure they are a Bank on Yourself professional and you'll be in good hands.
Well, and outline what are those key differences that, like with organic, you've got, hey, we don't spray with certain kind of pesticides. It's certain fertilizers are used, right? There's some metrics that you've got to hit and some checklists to get the organic. So what were those again for the Bank on
Yeah.
Yourself?
Well, like I said, there's about 29 of them. I'll give you a handful here on the podcast.
Sure.
And if folks want the full list, reach out to us at kickstartwithmark.com and I'll get you the full list. Just reach out at kickstartwithmark.com. A couple of them. It needs to be dividend paying whole life insurance. There's a lot of index universal life I would not recommend. It needs to be issued by a mutual life insurance company. It needs to have paid up additions as part of and a majority of the premium you pay, paid up additions being the most efficient part of the policy. I'll give you 2 or 3 more. It needs to have non-direct recognition loans. Non-direct versus direct. What does that mean? Well, if you have a non-direct loan, Brandon, what that means is the insurance company simply does not recognize, it's non-direct recognition. They don't recognize that you took a loan against the policy. This gives us that feature that allows your money in the policy to continue to earn interest as if you had never touched the money at all. And I've met people, I had a guy one time, he was a farmer. He had about 800 grand in 4 different policies, and they were whole life insurance, mutual life insurance company, had paid up additions. I mean, the list went on. And yet, when he borrowed against the policy, he didn't think so. His agent said otherwise. But the insurance company confirmed that when he borrows against his policy, and he had pulled roughly 800 grand out for a combine for his farm, he found out the hard way that the policies broke compound growth and charged him an 8% interest rate. He was furious.
Oh, wow.
So what we
Yeah.
did, he found a way to pay off the loan. We did what's called a 1035 exchange, similar to a 1031. and rolled that money tax-free into new whole life policies that were truly bank on yourself designed in all the right ways. I mean, we could go on and on. The load cost on paid up additions needs to be
Yeah.
under 6%. There's so many things you can do there, but that's a short list.
Wow. Yeah, interesting. Definitely go to that website and check those out because that's a game changer right there. Just because you get it doesn't mean that all policies are created equal. I like what you said there. I know we were talking about some of the income maximization strategies that you help clients with. Can you share what's working in today's environment? A lot of people feel like the current financial system is broken. There's a lot of hurdles now that weren't there. Inflation's in present, kind of back under control, but we all know that there's certain grocery items that are like 50% more than they were, 3, 4 years ago. And, a lot of people are struggling. So how are you navigating the current financial environment and advising your clients to have success?
Oh man, there's so many. And I know you guys do a great job of offering some incredible opportunities through your funds and your capital group. So I'll just add to what you're doing on this podcast so well. You're right. There are incredible pressures upwardly on prices. Inflation is a real deal. That's not, I don't think, going away anytime soon. And I saw a clip of Home Alone, where he pays like $20 and gets like 6 bags of full groceries for
Yeah.
$20. Like, wow, what a world that would have been. And the truth of the matter is most financial plans fail all of the all of the tests that most Americans are looking for. They want certainty. They want a concern. They want a confidence that their money's going to do what they want it to do. But when your money is tied up in tax deferred retirement accounts like 401ks and IRAs, you're going to be paying fees to the tune of 28% of your entire nest egg, according to the Department of Labor, a 1% assets under management fee that your friendly financial advisor is charging you will eat up 28% of your life savings over 35 years, according to the Department of Labor. That's a third of your life savings just gone to fees, my friend. I don't care if you know your financial advisor from church or college, or if he's the best, or he or she is the best gal on the block. 28% of your money gone to fees is not appropriate, in my opinion. What about taxes? Could tax rates go up in this country? Could inflation go up in this country? Do you want to pay those taxes? I don't. And most people's financial plans are going to be taxed in the future when the government decides they might be desperate for more of your money than they'll already take today. So there's market volatility. It's actually a myth that you can compound money in the stock market. You can't. As soon as you lose money due to volatility, you have broken compound growth and you can never get that money back. It's impossible to compound money when you lose money. It's just mathematically impossible to do. You can have volatility and it can go up or down and change in value, but it's not compounding because it's like starting and stopping the race car. It's like pushing gas and brake at the same time. It's impossible to
Yeah.
have an upward J curve when you do that. So what's some better alternatives? Well, let me give you a couple of quick ideas. One, whole life insurance on its own. Great. What a great way to plow money into something that will always and forever be a J curve upward and to the right. It's true compound growth. It grows on a guaranteed basis. You have liquid access to the money. And if we design the policy properly, it's tax-free access to the money in retirement. I just worked with a couple. They make 800 grand a year. He's a great doctor, anesthesiologist. He cannot even put that much money into a Roth IRA because he makes too much. But he can put any amount of money he can be approved for into a whole life policy. He's looking at doing several hundred grand a year into a whole life policy. Now, maybe you're listening to this and you're like, wow, good for him. Well, yeah, take a few zeros off that number. You can start with a couple $100 a month into one of these policies and it still works. Every little bit helps when you're thinking about plowing money into something that only goes up in value and never gets taxed again. Under current tax law, it stays tax-free. Okay, so that's the first. It's just plain and simple. Plow money into a policy. How about, let's do it. That's 101. Let's do 201. Let's plow some money into a policy and then borrow against it and go give Brandon a call. What might you be able to do if they had 6 figures of cash in their policy? Let's say they had 500 grand saved up in their cash value. Brandon, just help me out here. What would they be able to do with you if they came to you and said, hey, I could borrow 500 grand from my policy, get it in my, hot little hands in about a week. Brandon, we want to call you up. What could we do with that money?
Yeah, I mean, historically, we aim for 18% preferred returns with all of our equity investments. Obviously, past performance is no indication of future result. I got to say that. But yeah, you're arbitraging the difference there, borrowing it, low single digits and then re-lending it out for better opportunities to basically create more and more growth while you continue to compound in that insurance policy. It still continues to grow because you
That's
haven't
right.
actually taken money out of the policy.
Yep.
You have just taken a loan out against it.
Yep. So your policy might be doing some boring middle single digit return of 5-ish%, 4 to 6% is pretty typical, tax free, of course. And we might have a 1 or 2% loan against that APR wise. And then we lend it to you or give it to you, I should say, invest with you. And you might be able to get us no, guarantees, of course, preferred returns of 18%. That sounds like a pretty good deal. And I just increased my return without any additional risk in your investment, right? You might give us 18, but if I can get another, chunk of money arbitraged in my policy, I just increased my overall return without any additional risk, market risk, that is. And then finally, 301, I'll just finish with this. Every whole life policy can be transferred into an annuity as a 1035 exchange. Now, annuities can sound terrible, and again, Dave Ramsey loves to hate on these things, but annuities are nothing more than the best rental property you've never heard of. They are essentially a lifetime guaranteed income.
Mm-hmm.
Lifetime guaranteed income. Even if you ran out of money in your annuity, you would never run out of income. If I have a 401k with $1 million in it, I could outlive that money pretty easily, right?
Mm-hmm.
Over my retirement. But if I had $1 million in my annuity, it would pay me an income. And as long as I live or my wife lives, it would continue to just send us mailbox money. If we live to 105, 115 years old, that income is never running dry. And we can even leave some money to our kids if there's an account value when we pass away. To me, that sounds like an unbelievable, very efficient way to live my financial life without taking unnecessary risk.
If you're borrowing from your policy and buying like an annuity that's paying out like 6% annual, is it not offset by the debt payments that you owe back to the policy?
Oh, good question. Now, you are certainly able to borrow from your policy to fund an annuity. And I know clients that have done that. My reference in our little strategy there was to do what's called a 1035 exchange rather than borrowing from your policy, transferring your
Mm-hmm.
policy, basically getting rid of the life insurance and purchasing with no taxes due on the purchase an annuity. And it's essentially a
Oh,
like
I
kind
see.
exchange.
Okay. Yeah, moving into a different retirement vehicle where you're not getting
Correct.
penalized or paying anything on the
Yeah.
taxes right there.
So a lot of folks during their working years, they need money for kids' college, they need money for, house down payments or whatever, or investing with Brandon. But then when they get to age 60 or 70 or whatever, they're like, you know what? We need income. We need to turn our income on. So they'll transfer some or all of their cash value into a guaranteed lifetime income product like an annuity. And again, we can do that with no taxes or fees or penalties. And then they've got themselves an income stream they can never outlive.
Wow, that's an awesome strategy. I didn't know that you could transfer that whole life insurance policy into a different type of vehicle, like an annuity, down the road when you're ready to start getting that income. That's really interesting. Those were some great income strategies. I mean, you laid it out. A, B, C, D. I mean, these are all things that anybody can do, and they're very basic. Again, if you go and get a certified financial planner and somebody that has that extra
Mm-hmm.
certification, it's not just any policy. Well, I know that you guys are known for like the snowbank method, the lake growth snowbank method. Can you tell us a little bit about that?
Yeah, this is in sort of jest to the debt snowball method, where Dave Ramsey is famous for describing ways to pay off your debt. My debt snowbank method trademarked the strategy where we borrow against our life insurance to pay off any debt you might have. And again, the beautiful thing about this is your asset, the policy's cash value, is still earning interest even as you pay off your debts. So my wife and I did the math on this, and because we used our policies to pay off our debt, rather than just paying it off with cash the old-fashioned way, the Dave Ramsey way, we'll have several $100,000 more in retirement as a result.
Man, that's fantastic. This is an excellent strategy. Mark, if people want to learn more about you, learn more about your company, learn more about these policies and these strategies, where can they go?
Yeah, the best website is kickstartwithmark.com. If you've thought, hey, this might attain to me or this might pertain to me in my situation, if you're imagining, hey, maybe I could start one of these policies and reach out to Brandon for investment purposes, or hey, I really just need to pay off some debts, or whatever your situation, we can help. We do a full comprehensive review. We don't just jump to conclusions. Again, life insurance is just one of the tools that we offer at our firm. We are a full financial firm. This is one of the things we specialize in, but if it's something that's intrigued you, go to kickstartwithmark.com. We've got our calendar on there, some resources you can download, our YouTube channel, our podcast link is all there at kickstartwithmark.com.
Awesome. And yeah, we'll make sure that gets posted. Mark, other thing I want to ask you is kind of on my mind. Dave Ramsey, I feel like he's successful for a certain like niche of people, almost like, hey, if you're financially irresponsible, follow this method and it will work, because it does work for
Mm-hmm.
hundreds of thousands. I mean, probably millions of Americans with the
Mm-hmm.
reach that guy's got. So it works for some. What are some of the other myths or maybe some of the Ramsey principles that you disagree with that you realized as your journey to become debt free and start building wealth, you realize like, oh, I maybe don't need to take that advice.
Well, how many hours do you have? No, I'm just kidding.
Yeah.
I'll keep this real brief. I'm a huge fan of Dave Ramsey. He helped my wife and I get our budget straight. That's his
Yeah.
best part. He is very good at the baby steps, but I don't want to live my life taking baby steps. I got a marathon I want to run here, man.
Mhm.
So, some of the myths that I think are absolutely not just irresponsible, but maybe even devastating when he says things on his radio show that are not just wrong, but dangerously wrong, it makes us financial advisors, the hair stand up on the back of our necks. One in particular is you can get an average rate of return at all in the stock market. He says 12%. He may have come down to 10% lately. I don't know. But he used to say 12%. But here's the thing, averages mean nothing. Averages mean nothing. Here's what I mean. Let's say I invested $10,000 in stock A. 10,000 bucks, okay? So let's say you and I do this together. Stock A, we buy 10,000 bucks. It goes up in the first year to 20,000 bucks. Woo,
Mhm.
we're rich. We got a 100% rate of return. Second year, we lose half of our money. What are we down to at this point? 20,000.
100. Yeah.
Yeah,
15,000.
yeah, well, I'm sorry to throw some math, sorry to throw
Oh
some
no, you're
math
back
live on
down to
you, man.
10,000 if you
Back down
lose
to
half.
10,000.
Yeah.
That's right. So we went from 10 up to 20, back down to 10. How much wealthier are you? Not at all,
You're
right?
not. Yeah.
So you went up 100%, you lost 50%, you're back where you started.
Yeah.
However, your average rate of return was 25%.
Yeah.
Up 100 minus 50 divided by 2 years is 25. And Dave would tell you, congratulations, you got 25% rate of return. Your XYZ financial advisor, your oh so average financial advisor, would be patting himself on the back and taking your fee off of your account value for earning you nothing. And the SEC, the Securities and Exchange Commission, legally allows all this. I think it's a criminal act, in my opinion. I'm no law officer or anything, but that seems wrong. So the real investor returns, according to third-party research, okay, third parties, that'd be people like Dalbar and their research firm out of Boston, they say that over 30 years, the real return, the compound annual growth rate or the internal rate of return of your stock accounts, stocks and bonds blended, is about 3.6% over 30 years.
Hmm.
Now, if I'm expecting a Dave Ramsey 12 and I only get a real return of 3.6, when do I find out? Oh, yeah, when I'm 69 years old and I have no way to make that money up, right?
Yeah.
Life is like a roll of toilet paper. It just goes faster and faster the more you use it. You cannot roll that sucker back up again. You can't go back in time. So, to answer your question, sorry for the long answer.
Yeah.
The biggest myth is that you're going to get some sort of magical, mythical average rate of return. That's why our podcast is called Not Your Average Financial Podcast.
Yeah. I like that. If you look just historically, there was almost, I want to say it was like a 15-year period from the late 90s to like 2015, where the stock market literally did not do anything. It just went up, down, sideways for 15 years.
Yep.
And, and again, of course, we've had a really good run since 2009, and it's been
Right.
the, craziest bull market ever. But had you been somebody that was focused on that, 8, 9, 10, 12% return in the stock market, and you were 60 years old, and you're like, hey, just another 5 years, you would have waited to be in 75 before your
Wow.
portfolio would have continued to move. That's a huge problem. So I love how you broke that down. It made a lot of sense. Mark, this has been a pleasure. Thanks for sharing all your contact information. We'll make sure that it gets posted. And thanks for coming on the show today and sharing all your valuable insight. We've loved having you on as a guest.
Thanks, Brandon. Thanks for having me on.